Hello and welcome to Finance Walk. In this video we'll cover case on ratio analysis. Hello and welcome to Finance Walk. In this video we'll cover case on ratio analysis. We have seen different calculations of ratio analysis and how ratio analysis is important in equity research. As a financial analyst, there are different tools available to check whether the company is a really strong one or investable opportunity or not. In that, ratio analysis is one of the important tools in financial analysis. And as an equity research analyst or as a financial analyst, you should know how to calculate different ratios. Okay. All right, we'll start with this case. We have taken this case in manufacturing industry. Okay, so in this sheet we'll see we'll read out the case first. Okay, the Apex Manufacturing Company is a leading producer and exporter of engineering items such as steel pipes, ingots, billets, etc. It has also recently added a chemical plant and a paper plant as a part of its diversification strategy. The company started with a share capital of rupees 25 lakhs in the early 60s, which has now increased to rupees 225 lakh. The number of shares outstanding is 22.50 lakh. The average market price or AMP of the company's share during 2010-2012 has been rupees 26.38 in 2010, rupees 34.50 in 2011, and rupees 29.25 in 2012. The financial data for the company are given in next sheets. So next sheets will click on P&L sheet. Okay, so this is profit and loss account. You can see net sales, cost of goods sold, then gross profit, and you can see this is abridged profit and loss account. We can see it for 2010, then 2011, 2012 also, and here it's given. If you look at this column in 2012 net sales, then here gross profit is given, then different figures like profit before tax, this is profit after tax, effective tax which is 32%, and dividend distributed and retained earnings. Okay, with this let's move to next sheet, that is cost of goods sold. So in cost of goods sold is a statement basically about what goes in while manufacturing the product, and we can see here raw material, then direct labor, depreciation, other manufacturing expenses, then opening stock in process. Okay, closing stock in process likewise. So essentially this is cost of goods sold for 2012. We'll move to next sheet, that is balance sheet, one of the important financial statements. Okay, here it is given net worth, then borrowings, capital employed, current assets here. Okay, this is current asset, total current asset figure. Liabilities, this is current liabilities, net current assets, and then net assets, which is addition of fixed assets and net current assets. Okay, so we have this data, which is total number of shares outstanding, then company so market price, also market price in market. Okay, and share capital. Then next we have P&L, profit and loss account, we have cost of goods sold statement, and we have balance sheet. So with this data, let's check different ratios for this company and see how whether the company is an investable opportunity or not. Okay, So here in this sheet ratio analysis, we can see different ratios like liquidity ratios, financial leverage ratios, profitability ratios, and dividend policy ratios. Also turnover ratios we are going to cover. In second column we can see formulas for different ratios. We'll calculate ratios here, and we'll also interpret the ratios. Okay, so here first we'll start with current ratio. Okay, so we'll see first what are the liquidity ratios. Okay, liquidity ratios measure the ability of the firm to meet its current obligations. A firm should ensure that it does not suffer from lack of liquidity, and also that it does not have excess liquidity. The failure of a company to meet its obligations due to lack of sufficient liquidity will result in a poor creditworthiness or loss of creditors' confidence, and even in legal tangles resulting in the closure of the company. A very high degree of liquidity is also bad. That is, idle assets earn nothing. The firm's funds will be unnecessarily tied up in current assets. Therefore, it is necessary to strike a proper balance between high liquidity and lack of liquidity. Okay, so we'll start with current ratio. As we have seen in this formula, current ratio is calculated by dividing current assets by current liabilities. Okay, so current assets, okay, will go here, equal to sign. Then we go to balance sheet, because current assets are mentioned in balance sheet. Okay, so current assets, total current assets, it is current assets. Then go here, division sign, and current liabilities. Current liabilities, where do we find current liabilities? Okay, so current liabilities here, you can go down and see current liabilities. So current liabilities is how much? It is 715. Okay, so if you look at total current liabilities, it is 715.88. Please remember, we are calculating it only for 2012. Okay, so put enter, and then you have here 2.61 of current ratio as 261. If you want, you can make it only 2 digits like this. Okay, okay, so it is now 2.61. so current ratio for this company is 2.61. okay, so how to interpret this current ratio? Okay, as a conventional rule, a current ratio of 2:1 or more is considered satisfactory. Okay, so in this we can say it is more than satisfactory. So interpretation we can put is good. Okay, we can see more here. This company has a current ratio of 2.61:1. So it is always mentioned in case of 2.61:1. So I would write it here this way. So 2.61:1, which is good. So the ratio is good. Okay, therefore it may be interpreted to be sufficiently liquid. Okay, then see, this rule is based on the logic that in a worse situation, even if the value of current assets becomes half, the firm will be able to meet its obligation. The current ratio represents a margin of safety for creditors. Okay, so the higher the current ratio, the greater the margin of safety, or the larger the safety for creditors. The higher the current ratio, the greater the margin of safety. Okay, the larger the amount of current assets in relation to current liabilities. the more the firm's ability to meet its current obligations. Okay, so here one thing is clear, this company is very good in current ratio. Okay, so with current ratio, let's move to next ratio, that is quick ratio. Okay, what is quick ratio? Quick ratio establishes a relationship between quick or liquid assets and current liabilities. See, inventories are considered to be less liquid because inventories normally require some time for realizing into cash. So their value also has a tendency to fluctuate. The quick ratio is found out by dividing quick assets by current liabilities. So now what is the quick ratio? Current assets minus inventory divided by current liabilities. Okay, so we'll calculate here. Let's go here, put equal sign, and then go to balance sheet. Why balance sheet? Because we'll find current assets and inventories there. So here it is, go put my equal to sign, and then current assets, it is current assets here minus inventories. So inventories, this is inventory. Okay, inventories. Now you can put parenthesis here. Okay, and this divided by current liabilities. Okay, so go current liabilities, balance sheet, current liabilities, this is current liability, and put enter. Okay, so here it is. So 1.01. okay, so 1.01 is to 1 is quick ratio, which I think is good one. Okay, so thus if this company's inventories do not sell and it has to pay all its current liabilities, it is easy for this company to meet its obligations. Okay, because its quick assets are 1.01 times of current liabilities. So how it can be written as 1.01 is to 1, which I think is again good. Okay, with this let's move to next ratio, that is cash ratio. Okay, so what is cash ratio? See, since cash is the most liquid asset, a financial analyst may examine cash ratio and its equivalent to current liabilities. Trade investment or marketable securities are equivalent of cash. Therefore, they may be included in the computation of cash ratio. Okay, so here we can see cash ratios formula is cash plus bank balances plus marketable securities divided by current liabilities. Okay, so for this company, cash, let's calculate cash plus bank balances. Go to balance sheet. Okay, so go to current assets. Here it is cash and bank balances. For 2012 it is 26.08. okay, and divided by current liabilities. So this divided by current liabilities is this. So according to this formula, this is 0.03, or if you want to put it in percentage terms, go here. See, this is 4%. okay, so 4%. Okay, so for example, the company in our example carries a small amount of cash, that is 4%. So there is nothing to be worried about the lack of cash if the company has reserve borrowing power. So in India, firms have credit limits sanctioned from banks and can easily draw cash. So I would say this is again a good measure. So we can put this interpretation as good. Okay, so after calculating liquidity ratios, we can move to financial leverage ratio. So what are financial leverage? So we need to check how much company is company has taken loans and its capital structure also. So we'll go to we'll see first ratio in this, that is debt equity ratio. The formula is debt divided by equity. Okay, so total debt divided by net worth is the formula for debt equity ratio. We'll calculate here. Let's see total debt. We need to go to balance sheet. Okay, so total borrowings is 1229.06 divided by total net worth, which is 672.81. Then press enter. 1.82. Okay, so let's see in this format. So 1.83. so what does it indicate? 1.83. okay, so again 1.83 indicates that it is clear that from the total debt ratio that this company's lenders have contributed more funds than owners. So lenders contribution is 1.83 times of owners contribution. So this is called debt equity ratio. I would suggest for manufacturing companies, yes, sometimes the amount is invested or invested in basically fixed assets or gross block. So in that case, a company is leveraged. So this I would put okay, not great or good. So 1.83 or we can put it as 1.83 to 1, 1.83 to 1. So okay, interpretation is okay. So after that, let's move to interest coverage ratio. So what is interest coverage ratio? See, interest coverage in interest coverage ratio, we need to check how many times the particular interest or the company is earning in relation to interest. So EBITDA, or we can call it operating margin, is how many times of interest. Okay, so in this interest coverage ratio, that is EBITDA divided by interest. So the interest coverage ratio shows the number of times the interest charges are covered by funds that are ordinarily available for their payment. So since taxes are computed after interest coverage is calculated in relation to before tax earnings. Okay, so depreciation is a non-cash item. Therefore, funds equal to depreciation are also available to pay interest charges. So we can calculate the interest coverage ratio as earnings before depreciation, interest, and taxes, or EBITDA divided by interest. So here EBITDA for EBITDA, let's go to P&L, put equal sign, then go to P&L. Okay. EBIT, that is earnings before interest and tax, 342.61 divided by interest. So here interest figure is 142.46, and now put enter. So this is so 2.39 times or 2.4 times. This is interest. So this ratio, the interest coverage ratio, or the times interest earned, is used to test the firm's debt servicing capacity. The interest coverage ratio is computed by dividing earnings before interest and tax by interest charges. Okay, so here I would say it is good. The company is able to generate the amount or profit or earnings, in short, that it can service interest easily. Okay, so I would say this is a good ratio in this particular company's case. Okay, so with this we'll move to next area, that is profitability ratios. See, profitability ratios are most important ratios for an analyst, then shareholders. So you need to see how this ratio is calculated. Okay. It is gross profit. First, we'll look at gross profit margin ratio. So gross profit divided by net sales is basically the gross profit margin, and if you want it in percentage terms, then you need to multiply it by 100. Okay, so this is gross profit margin. Also, we can calculate net profit margin, which is same way, that is profit after tax divided by net sales, and that is multiplied by 100 again. Okay, so first we will start with gross profit margin. The first profitability ratio in relation to sales is the gross profit margin, or simply gross margin ratio. It is calculated by dividing the gross profit by sales. Okay, so here gross profit margin is nothing but sales minus cost of goods sold divided by sales. So let's see for this, let's calculate for this company gross profit margin ratio. So for gross profit margin, go to P&L and check gross profit here. So gross profit is 663.57 divided by sales. Okay, so net sales is 3717.23. okay, and then press enter. This unit, this in percentage terms, so check here percentage. So 18% is gross profit margin. Okay, so this gross profit margin reflects the efficiency with which management produces each unit of product. So this ratio indicates the average spread between the cost of goods sold and the sales revenue. I would say 18% is good, but you need to see this in comparison with other companies or other players in the same industry. I would say good here. Okay, then go to net profit margin ratio. Net profit margin ratio, profit after tax divided by net sales into 100. So profit after tax, $134.86 divided by net sales. Net sales is 3717.23. okay, yes, now it's correct. And you want it in percentage terms, so go here, check percentage. So net profit margin is 4%. Okay, so if the non-operating income figure is substantial, it may be excluded from PAT to see profitability arising directly from sales. For this company, operating profit after taxes to sales ratio is 4%. So what does net profit margin ratio does? It establishes a relationship between net profit and sales and indicates management's efficiency in manufacturing, administering and selling the products. This ratio is the overall measure of the firm's ability to turn each rupee sales into net profit. So if the net profit margin is inadequate, the firm will fail to achieve satisfactory return on shareholders' funds. Okay, so I would say again okay ratio. This is okay ratio, net profit margin in this company's case. We'll dig deeper because we need to check this ratio in comparison with other players in the same industry. Okay, so with this, let's move to next ratio, that is return on capital employed. Okay, so return on capital employed is one of the important ratios. So return on capital employed, the formula is EBIT into 1 minus T divided by net assets into 100. Okay, so here we can see what is EBIT. We have calculated EBIT, that is go to P&L. EBIT is 342.61 multiplied by 1 minus, so this is multiplied by 1 minus T tax rate, that is 0.32, okay, divided by net assets. So net assets, go to balance sheet, check net assets. So these are net assets. Okay, so return on capital employed, you can check in percentage terms, is 12%. Okay, return on capital employed seems good to me, so I'll put good rating here. Okay, return on with this, let's move to return on equity. So what's the difference between return on capital employed and return on equity? See, return on capital employed is the measure which measures the return for debt holders and equity shareholders both, whereas return on equity measures the earnings or return for equity shareholders only. So if you look at the formula, it says profit after tax divided by net worth. Earlier it was net assets, here it is net worth into 100. So let's calculate return on equity. Okay, so return on equity is profit after taxes. So profit after taxes, go to P&L. It is 134.86 divided by net worth. For net worth, you need to go to balance sheet, and here is net worth figure, that is 672.81. Press enter, and this is the figure. We want it in percentage terms, so it is 20%. Return on equity 20%, I would say very good return on equity, that is 20%. So anything above 15% is considered to be really good, because Indian companies average rate is 15%. So if you get any company which is consistently giving a return on equity higher than 15%, consider it is a really good company. So in this case it is giving 20%, so I would say good measure. Okay, after this we'll look at earnings per share. You might have heard this EPS jargon, in financial annual reports or financial dailies like Economic Times, Business Standard. So what is EPS? EPS is calculated as profit after tax divided by number of common shares outstanding. Okay, so here we will check profit after tax, which is given in P&L. Okay, so profit after tax is 134.86 divided by number of common shares outstanding. So number of common shares outstanding is for that we'll go to case. Here it is given total number of shares outstanding is 22.50 lakh. Okay, so here go to, okay, so 22.50 lakhs. Okay, press enter, and since we want it in this format, okay, so 5.99, if you want to remove these decimals, then 6, so rupees 6 is earnings per share. So earnings per share is 6, that is per share the company is giving you 6 rupees. I would not say it is good or bad unless I check the track record and other comparative comparable companies in this industry. So you need to see the trend in this, so you need to see whether the trend it's a good trend or it's in growth phase. And earning per share, it's growing by at least 5%, 10% or 15%. So in that case we need to check. So I would say need more analysis. Okay, then check price earnings ratio, okay, or P by E ratio. So P by E ratio, PE ratio is also, we have seen in presentation how to calculate it and what's the importance of price earnings ratio. So price earnings ratio is calculated as market price per share divided by earnings per share. Okay, so this PE gives you a very good measure of how much or how many times the particular earnings per share is measured in terms of market price, or what's multiple the market is giving to its EPS, that is earnings per share. So market value per price per share. So for that, go to this first sheet, that is in 2012 it is on average average market price has been 29.25. so go to ratio analysis, then it is 29.25 then divided by earnings per share. So this we have just calculated earnings per share, that is 6. So let's see price earnings ratio. Price earnings ratio is 5 times. So it's good. I would say it's good because the price earnings ratio is widely used by the security analysts to value the firm's performance as expected by investors. This ratio indicates investors' judgment or expectations about the firm's performance. Management is also interested in this market appraisal of the firm's performance and will like to find the causes if the PE ratio declines. So I would say price earnings ratio is good. Of course it's good because if you see it, normally companies having less than 12 or 15 PE is considered to be good, but again it needs more analysis because we need to check other financial variables for this. For me, the company is profitable, the net profit margin is good. One more thing we need to look at is cash flow also. We'll check that in some time, but again price earnings ratio looks good to me. Okay. With this we have completed profitability ratios. Then we'll move to dividend policy ratios. Okay, so dividend policy ratios, one of the important variable for investors. Okay, so first we'll check dividend yield ratio. Dividend yield is calculated, formula is dividends per share divided by market price per share. So dividend yield, so dividend per share. So where do we find dividend per share? Okay, dividend per share, let's go to P&L and check whether it's given there. Yes, dividend distributed is 45. So if you calculate that, or let's check whether dividend is given anywhere apart from P&L. Okay, so dividend distributed is 45. Okay, it is 45 lakh. So let's see, let's say dividend per share is 2 rupees. Okay, for our calculation we'll take dividend distributed as 2 rupees. Okay, so here 2 that is dividends per share, divided by market price. So market price, we know it is 29.25. okay, so we'll check dividend yield. Dividend yield in percentage terms, it is 7%. I would say very good company in case of dividend yield, because if you, it says that if you invest 29.25 rupees, which is market price of the share, you are going to get 2 rupees, so which is 7%. So this is also a consistent earning for equity shareholders. So 7%, I would say it's really good. See, you invest in shares basically for two reasons. One is getting dividends, and second for capital appreciation. The companies which are giving dividend to shareholders consistently are rewarded highly, okay, or are valued highly. So 7% according to me is really good. Let's check it. Let's go to next ratio, that is dividend payout ratio. Dividend payout ratio is calculated as dividends per share divided by earnings per share multiplied by 100. Okay, so dividends per share is we have calculated dividends per share is 2 divided by earnings per share. What is earnings per share? It is this figure 6. Okay, so press enter, and we want it in percentage terms, so go here. 33% dividend payout ratio is 33%. Okay, what does this mean? Earnings not distributed to shareholders are retained in the business. So payout ratio is 33%. So I would say 100 minus 33. So that ratio is called retention ratio. Okay. So it's good, because more than 1/3 of the total earnings is distributed as dividend, and 2/3 is retained for further investment. So I would say good. Okay, so as long as the company keeps this track record, then in that case company is really managing its finances well and keeping the investors happy also. Okay, so with this we'll move to turnover ratios. So what are turnover ratios? Turnover ratios are the ratios which which is always quoted in multiples. Okay, so inventory turnover ratio is calculated as cost of goods sold divided by average inventory. Okay, so cost of inventory turnover ratio indicates the efficiency of the firm in producing and selling its products. Okay, it is calculated by dividing the cost of goods sold by the average inventory. Okay, in a manufacturing company, inventory of finished goods is used to calculate inventory turnover. Okay, so let's start calculating inventory turnover ratio. Okay, so we need average inventory, so let's calculate average inventory first. Okay, so average inventory, go to balance sheet, calculate here average inventory. So average inventory of finished goods, so this is 244.28 plus 461.81, this divided by 2. Now this will give us average inventory. 353.045 is average inventory. Okay, now with this let's go to ratio analysis sheet and calculate cost of goods sold. So cost of goods sold is 3053.66, this divided by average inventory. Okay, So 8.64. Okay, we'll put it in 2 decimals. So 8.65 times inventory turnover ratio, which is I would say good. So this is turning its inventory of finished goods into sales 8.65 times in a year. In other words, it holds average inventory of 1.4 months. That is, if you divide 12 months by 8.6, it will give you 1.4 months. The reciprocal of inventory turnover gives average inventory holdings in percentage terms. Okay, so I would say good. See, this ratio is always in times. As I said, it is multiple, it is in times. So 8.65 times. So the ratio is good. Now let's see the total assets turnover. This is again important because as the company invests highly in total assets, we need to see the impact of this investment in sales or revenue also. So higher the better. Higher this ratio is the better. Okay, so we'll calculate now total assets turnover, which is net assets divided by average total assets. Okay, so first we'll calculate average total assets. Go to balance sheet. Average total assets. For average total assets, calculation should be net fixed assets plus current assets. So 2617.75 is the total figure for total assets. Okay, so now we'll go to ratio analysis sheet and net sales. For net sales, we need to go to P&L. Net sales is 3717.23. That divided by total assets. Total assets we have calculated in balance sheet, that is 2617.75. Press enter. That equals to 1.42 times. So it is 1.42 times. So it says the total assets turnover of 1.42 implies that this company generates a sale of rupees 1.42 for 1 rupee investment in fixed and current assets together. Okay, so I would say it is okay, not great. So since it is only 1.42 times, every time the company invests 1 rupee in total assets, it will only generate 1.42 net sales, which is again not good. Okay, so through this ratio analysis, we can see the financial position of company, and this financial health, especially for the company, is okay, because the current ratio is good. Then quick ratio, again I would say good. Cash ratio 4%, then about 4% is held in cash, which is good. Debt equity ratio is 1.83. It should be ideally less than 1, but since it is manufacturing company, the company is highly leveraged, so company should look at this ratio once again. Interest coverage ratio 2.3139 is good again. Gross profit margin 18%, good. Net profit margin is 4%. I think we need to. I mentioned it's okay because we need to dig deeper and check why it is only 4%. If it is industry standard, then we have to accept it. Return on capital employed is 12%. Good. What as shareholder you should be interested in? Return on equity, which is 20%. So as I mentioned earlier, more than Indian companies average is 15%. More than 15% is better. and in this case it is 20%, so I would say it's really good. Earnings per share is rupees 6. We cannot comment on standalone figures, so we need to dig deeper and check the trend. So we need more analysis for this. Price earnings ratio 5 is, P ratio is 5 is again good. So anything, any company as PE is less than 12, I would say good. So since I've mentioned it here good and need more analysis, we need to dig deeper. Next ratios are dividend policy ratios. Dividend yield is 7%, which is again good. Dividend payout ratio 33%. That means company is distributing 33% of its earnings, and remaining 67% is retaining for company's future plans. Okay. Turnover ratios, inventory turnover ratio. So 8.65 times is good in this for this company. And the total assets turnover 1.42 times. I would say it is just okay. This ratio is just okay for this company, because I would expect anything between 3 and 6 times for this company. But so I've mentioned here it's okay. So with this, I would say we need to check whether the company is really good or not. In my case, the company is good, but in some cases, company can do much better. But again, this, as I said, this ratio analysis, these ratios, we have to compare it with different players in the same industry.